Very good morning, guys. Welcome to the briefing then for Tuesday the 21st of June. Just 2 days now till the EU referendum. I thought I'd start with a very famous quote. We live in a vibrant and connected world where together as people we are strong. I ask you, who said those famous words? Was it Winston Churchill? No. David Beckham this morning, pinning his mast to the EU Remain vote. Golden balls have spoken, so we must follow. But looking at cable then, yesterday, showing with you top left the chart for cable from the gap up that we had from the recommencing of electronic trade from Sunday night through yesterday's session and to where we are this morning, because the dollar once again is slightly weaker, which has elevated both major pairs. And cable now sitting just above the 147 handle. Again, gains of 2.7% for cable. And for a lot of you guys who've not been in the market for too long, these are unprecedented kind of sized moves that we're seeing. It goes to show how much fear was almost built in and priced into the pound before we had that swing back to some of the Remain polls seen at the weekend. Looking at it in a bit more clearer way, we can see this chart from the FT this morning. So the pound had its biggest one-day gain. It's the third largest we've seen in the past decade. Now, quite interesting, just looking at those dates, you'll probably realise what happened, or if you can, back in late 2008. Of course, that was the bankruptcy of Lehman Brothers. September the 15th of 2008 was when the dollar was getting pulverized and things like the pound at the time were relative flight to quality in comparison. And as such then, 2008 really takes up the majority of these boards for the biggest up moves we've seen in cable, apart from that move that we had yesterday. So the 20th of June, quite a historical day in terms of the size of that move. We've added to it slightly again this morning. One of the things, just if I put this on a shorter dated time frame, just to have a look at, is this wick here that you can see at around 6 o'clock last night. Again, we moved around a point and then bounced back within the course of about half an hour or so. Now, this is when some of the latest polls came out, so just to quickly get you up to speed, there's 3 of note. The first was from the National Centre for Social Research. This is probably a lesser one to the main regular pollsters, but they had 53% to 47% in favour of Remain. The second, from ORB Telegraph, this was conducted over the phone, showed 53% to 46% leads in favour of Remain. When included the decided voters, and 49 to 47% including the undecided. The only one that kind of bucked the trend slightly was YouGov, the final of the 3. They saw 44 to 42% lead for the Leave camp. So a little bit of a mixed interpretation, but the wick here that I'm showing you, the reason why I'm pointing that out is, again, we've been talking about it the last few days, is this lack of liquidity and the repercussions that can have on price action. Particularly at that point in the day, pretty late on, most of Europe and the UK would have gone home, so that's going to lessen the volume as well, and it's going to exacerbate some of the price movement, and that's when some of those latest polls dropped. The YouGov one was a bit of surprise, the fact that it was still leading to Leave, but the others, the overwhelming bias still, the Remain has gathered some steam. Another very interesting stat that I've seen as well, following the kind of tragic situation that happened to that UK politician, Joe Cox. The Telegraph poll that came out overnight, they also ran a survey on expected turnout numbers. Now, as you'll know, the turnout is particularly important, has been spoken about a lot for the Remain vote, because generally speaking, the people who backed Remain from the start have been of a kind of more passive stance compared to the more outspoken and opinionated campaigners for a Brexit. Now, that Telegraph poll on their survey last night on turnout numbers revealed that among Remain voters has increased 9 percentage points over the last week to 69%, while the turnout for Leave voters has now fallen 4 points to 64%. That's another very important part of the puzzle if Remain are to secure a win. One of the other things as well, just looking at the various newspapers this morning, the front of the business section in The Guardian, looking at the legendary investor George Soros, is getting a bit of airtime, saying that it's a reasonable assumption that under a Leave outcome would be for a drop in the pound of at least 15% and possibly more than 20% to below 115. Again, we are trading at 147 handle this morning. Keep in mind though, that is at the more extreme end of the scale of what most investment banks are kind of calling for. They're looking at more a 10% kind of move if that were to materialise. In terms of the story for cable today, you can obviously just keep an ear out for any updates in the polls. I think, if I remember correctly, IG, the spread better, have commissioned another Survation poll, and I think that's coming out later this afternoon, so I'll keep you informed when that comes out. There's usually a live link on the IG website, which is free, and they give you a countdown where you can get the news as it breaks. So that'll be one to watch. And then obviously you've got that live televised debate, Wembley Arena heavyweight contest, Boris Johnson against Sadiq Khan. That's going to be a big one for the decision making of the still undecided as the countdown draws closer. So that's kind of the latest state of play there. Other things from overnight just to be aware of, just looking at the Japanese yen, let me just bring that into shot. We're a little bit weakness overnight. We did have the BOJ minutes, nothing really too exciting here, but it did help bolster the Nikkei stock index as the yen seen some weakness, relative risk on mood still being seen across asset class at the moment, carrying on from yesterday. Asia broadly was higher overnight. The Aussie dollar also seen a little bit firmer. The RBA had minutes overnight, the central bank signalling optimism in the economy, suggesting then a lack of urgency for any further cuts. Ticker there DA6, U6, if you want to have a look on CQG. But the Aussie dollar also a little bit firm, and just testing up around its R1 at the moment. A quick look at one other thing that's getting run in the likes of the FT. Hasn't really drawn too much attention, but it's something which I thought I should speak about from more of an educational point of view, as I don't really think it's going to have too much of a real market impact. And that's the German High Court today, a ruling on the legality of the ECB's OMT. That's the Outright Monetary Transactions program. So what is it? A lot of you might not be familiar with it. Essentially, back in the sovereign crisis, so you have to go back to around 2012 when Europe was at its most, or the situation was at its most dire. That was at the point where a lot of the talk started to come about purchasing of sovereign debt, i.e. countries' bonds. Draghi coined that infamous phrase, whatever it takes. And then actually when he said that, through the power of words and communication, the market actually saw a pretty strong turnaround. But nonetheless, a program later that year, in 2012, was put into place. This was the OMT. Now, the crux of that program is a pledge to buy Eurozone government bonds in potentially unlimited quantities to counteract any sharp rise in borrowing costs for Eurozone governments. Now, a very important thing here is that the OMT has actually never been used. So it's been around for about 4 years, but thankfully the ECB's never had to go to that option. It does act though as one of the main tools of what's helped at the time the market turn around, because it's just the fact that the program exists and ECB have gone about making it, which seemed to have been enough at the time to ease some of the market sentiment. Now, there's quite a big difference between what the OMT is and what QE is at the ECB, because we know that the QE bond buying is now underway. While both programs involve buying government bonds, the ECB has unleashed its QE to hit its inflation target of just under 2% and not to counter bouts of market volatility, the latter of which is really the key of why the OMC was made. No surprise then, the Bundesbank, the most hawkish of ECB view, has repeatedly complained about the OMC. It has made many fewer objections though about QE, which it recognises as legal as it's part of within the ECB's central bank's mandate. Because obviously the mandate is to hit 2%. However, the mandate of the bank is not to prop up countries by buying their own bonds. That's the key difference. European law, it forbids the banks, the central bank, from buying from governments and participating in so-called primary markets, as this contravenes rules on direct financing of states by central banks. But the European Court of Justice judgment allowed the ECB to buy bondholders in a secondary market as the central bank sees fit. So the reason why it's important then is because it's the German High Court, and they could, I guess, throw a spanner in the works, so to speak, and cause some issues from a legal standpoint, saying that it kind of contravenes European law, that the OMT should not be allowed. They're very much against the financing of sovereign states. So could be something to just look out for if we see some headlines hit. That's what it's about essentially. The court decision is said to be due at 10 a.m. local time, so actually 9 o'clock London, so we should be looking out for that in the next half an hour or so. Moving on, we have Yellen today in terms of some of the key things to look out for on the intraday schedule. Let me just bring that into focus. As mentioned, you've had the BOJ and RBA minutes already. This morning, the main kind of data release is the German ZEW Economic Sentiment Index. That could be quite interesting just to see what the current state of play and particularly people's outlook going forward. Again, this is an index measurement, the level of optimism that analysts have about current economic situation and expected economic developments for the next 6 months. So that'll be one to watch later. You've got Fed's Yellen speaking the Humphrey Hawkins testimony. Now, for those who've not heard of that before, this is one of her key speeches historically she gives during a year. It's like a semi-annual speech. The only thing is, this one is slightly different because of the close proximity. We've only just had the FOMC's latest communication with their dot plot matrix projections update allied to the press conference from Yellen, has then to a large degree meant that this today is probably going to be just a rehash of what we've already heard. Very unlikely, I think, that we'll get any great movement in the market on the back of that, but normally this is one of the biggest events that you'll see out of the US on a kind of semi-annual basis. The other thing as well, of course, on the macro backdrop, much of the market waiting for the referendum. I think that was very much the case yesterday. You guys here who are trading the markets live throughout the session, obviously yesterday was pretty slow going in terms of the actual session volatility. The big move happened pretty much overnight, and then it was pretty hard to trade otherwise, identifying kind of good entry points as we went. Just wrapping things off, quick look at oil. We've got the API crude oil inventories, of course, aftermarket tonight. DOEs to follow Wednesday. $50 handles still providing a bit of a psychological barrier. We did see that test just before the NYMEX pick close last night, before it found again a bit of a close test early Asia Pac hours before we saw a decline back to pivot. So pretty much mid-range at the moment between pivot, 49.52 and the $50 handle. Okay, that wraps up though the briefing for this morning. So enjoy your session, and I'll be in hot comms throughout the day. Thank you.